let's also connect with our guest then. Taimur Beg is joining in, MD and Chief Economist at DBS Bank. Thank you so much for taking time out. Just going by, the kind of news flow and the global cues that we're getting in. While yes, of course, you do have Wall Street, which is continuing to scale life highs. When it comes to the kind of rate cut moves that we've seen or an easing back of central bankers' decision, do you believe that that is going to now be the course of action when it comes to global central bankers?
I think global central bankers got confused by the Fed in the last 4 to 6 weeks. The Fed was reticent about doing large rate cuts. Then it, at the very last second, sent out signals that it was going to go ahead with a large rate cut. And now looking back, it seems like the large rate cut was not the right thing to do because the US economy is not slowing by any measure. Look at nowcasting growing at over 3% for the third quarter. Look at retail sales that come out overnight, significantly better than expected. So 25 basis points calibration, I think, would have been a source of stability for global FX, global equity sentiments, and global central banker sentiment. But so I would sort of blame the Fed for some of the volatility that we've seen over the last 4 to 6 weeks. It was a premature rate cut on the premise of a sharp economic slowdown. It's been proven to be wrong. And now you can see whether you see the body language of the ECB or the central banks in Southeast Asia, everybody's sort of struggling that do we go ahead and cut one more time? Do we wait for the Fed's November meeting and December signal? We're right now at a bit all over the place, a degree of confusion and volatility. And you see that most starkly manifested in the fixed income market, the way the yield curve is twisting and turning right now.
So, Taimur, what is the new normal for the world? Is it slowdown in Europe, comeback in China? What is the new normal now?
Well, the comeback in China story is an interesting one. Just before coming onto this call, I was looking at the top 5 best performing equity markets in Asia this year. And India is not there. India is in the top 10, but not in the top 5. Top 5 would be countries that were super distressed, extremely undervalued, like Pakistan and Sri Lanka, but they don't really matter because they're tiny stock markets. But then you look at the chunky ones that have done very well in the last 1 year. It would be China, Taiwan, and Malaysia. So look at the 3 countries with 3 contrasting narrative, and that to me is the story around equity markets going forward. One is large consequential economies that have deep value, and I think China would be one of them. It has lots of problems, but certainly you could argue there are companies with extremely attractive valuations which could provide decent return to their shareholders. Then you have a country like Malaysia, which has been sort of a fallen angel for a very long time, an IT tech powerhouse which sort of lost its way over the last 2 decades. It's got its mojo back. Global semiconductor manufacturers, data centers are all lining up to go to Malaysia. Stock market is doing very well. And Taiwan, we already know, basically the node of the most advanced manufacturing in the world. Of course, those companies there would do well. Now, the fact that the likes of India, the likes of Singapore are still in the top 10 tells you the new normal is not that different from the old normal. Countries that do provide deep liquid markets, have a wide spectrum of companies to pick and choose from, will remain on the menu of global portfolio managers, regardless of what we call the new normal around Fed narrative or China turnaround. They will stay in the top 10, which is a good place to be in.
Sure. But Taimur, what's the read-through when it comes to India? Because, while many would want the rate cut, inflation continues to be a niggling worry. It's been a status quo from the RBI for the longest time now. And yeah, it's a market where you don't have valuation comfort. And yes, even the rural segment of the economy not really firing, not really coming back full swing, that continues to be a problem. The bigger alarming factor is also some of these two-wheeler companies, case in point being Bajaj Auto, which came out with its numbers, and they're not really sounding gung-ho about whether the festive season can bring about that, upswing in demand.
Well, I don't. So I concede all those points, but I don't think it is because nominal or real interest rates are too high in India. I don't think that's the reason. I think the reason behind the equity market fatigue is obvious. It's run very strong. Global portfolio managers have other options. It is not necessarily something to deal with India in particular. It's the valuation of the market and the rest of the world's behavior. But when we talk about the overall economy, particularly the rural economy, I think there are a variety of factors, and interest rates is one of the, in my view, minor contributors to that stress. I think we need better job creation, a better narrative around industrialization and manufacturing, quicker policy transmission from the various things that are being done in Delhi to the grassroots level. And those things, are not things that happen overnight. You need, concerted, proactive policy action, and then that shows up. I mean, think about the early days of the Rural Employment Guarantee Program. Think about the early days of Aadhaar and the transfer. It takes time, but they take hold, and that sort of structural measures, I think we need further dose of going forward. Short of that, this 6-7% growth narrative that we have around India, which, by the way, is a very good narrative. I mean, we're sort of spoiled with good data that we want even better, which is fine. But to get to that next level where growth would be 7% plus, we probably need another fresh dose of structural reforms. Frankly speaking, that's not in the horizon right now. And maybe that is the reason why we don't see any additional delta with the growth narrative. But by and large, the growth narrative is solid. It's just that we demand much, much more, and we're not getting it.
All right, Taimur, thanks so much for joining in and sharing
Pleasure.
with us your thoughts on all that's going on across the globe, the macros, and of course, the central bankers' actions.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.